Welcome to Week 7, Module 1, Charitable Transfers. This week we're a little bit different than the previous weeks. In the past we'd have a separate module for each topic. This time we're going to have two modules on charitable transfers, and that is because, quite honestly, I think that the textbook does not spend as much time as I think it should in this area. The reason they don't is because it's not a real big subject on the CFP exam. However, in your practice, you're going to find many of your clients are going to be very interested in charitable transfers, and they want different methods how to do it, and I want you to be aware of what type of methods can be used. I might note that if you have a charity in mind that your client would like to use, the charity will probably provide services to you, from doing all of the legal material, doing all the taxation material, even giving you brochures, etc., on the charity and on the methods that they recommend for having the transfers to them. They are extremely helpful. Also, they do hire the very best lawyers and tax people. When I've dealt with charitable institutions, I've always felt I'm dealing with the best of the professionals. So they are really a good source for you when you're dealing with a client on charitable gifting. So we are going to look at a number of different techniques, some of which you may be familiar with, some you're not. And I might note a lot of these techniques we're showing you are developed by attorneys, very creative, and as long as they're within the tax law for charitable gifting, and if they're fine. And I would also say that, remember, also the purpose of these is to get assets out of the estate. So let's take a look at them. First one is going over some of the different rules between income tax and gift tax. I think one of the problems people have on the CFP exam and in practice is confusing the gift tax and the income tax rules regarding gifting, because the rules are considerably different. For example, the income tax deductibility limits charitable gifting. Well, for gift tax purposes, there is no limit. There's a 50%, 30% limits, I think, of adjusted gross income on the tax return for tax deductions in a year, but for gifting, there is no limits. Income tax distinguishes between public and private charities. Gift tax doesn't. In fact, gift tax even uses the terms differently. They call it a foundation rather than a private charity. Income tax benefits rely on charitable use of assets, while gift tax doesn't. So dealing in income tax, the amount of deduction I get depends on how it's going to be used by the charity, as well as what type of asset it is. And as again, you've got the caps of maximum gifting. Gift tax requires gifts to be qualified, and income tax doesn't. And again, another big difference. I might note that one thing they have in common is it must be a gift to a charity recognized by the IRS. That is the one commonality between both types, and you would find those lists of charitable organizations at the IRS website. Outright gifts to charity. This is where a transfer in which the donor retains no interest or control is by far the easiest, and the charity has the right to use or distribute the property as it wishes. So there's no restriction on a charity. That's the outright gift to the charity. You put a restriction on it, then it is no longer an outright gift. Gifts that are good and those that are bad, I guess the best way of putting it is gifts appreciated property make good gifts, because you get the benefit of the fair market value for gift tax purposes rather than your basis, although that is not true for income tax. And the gifts of long-term capital gain property given to public charity and under 30% of AGI qualify for the income tax benefits. So if you can get a gift that falls in within the criteria of the income tax, it also has a low basis and high fair market value, that would be very appropriate for gifting. Life insurance to charities. These are relatively small gifts because the premiums are very low, where the charities get a substantial payout. And just like it is a great gift to give to people, it's also a great gift to charity. Um, and if there is a policy in existence that you're gifting to charity, which in most cases it is, the gift tax deduction is the lesser the donor's cost or the replacement cost of the policy. You will get the replacement cost of the policy from the insurance company. They will give the information to you. That information that you get from them is also acceptable to the IRS. So you don't really have any problems with the IRS on that. Gifts of future interest. And for a uniqueness, unlike income tax, for gifting and gift tax, it is not a complete gift until all rights and possessions have been transferred to the charity. So if I have a situation where I have a present interest for a family member and then it goes to the charity, it is not going to be a gift until they get the full dominion and control, which is after the family member's life estate is over. And that again is different than for income tax. Foundations, which is what the gift tax rules refer to as private charities, which is a term used for income tax. There's a big advantage of gifts to foundations in lieu of public charities, as control can be retained by the donor. In fact, for a lot of my clients are what I call control freaks, and they love to control the gifts after given, and foundations are great for that. I know when I was taking these courses, the recommendation was a foundation should be $2 or $3 million as a minimum, but I've seen articles recently in magazines that say today 500,000 is a nice number for a foundation. So it's much lower and much easier for your clients to get into that today. It must be set up for charitable, religious, scientific, literary, or educational purposes. In other words, the purpose of the foundation must be clearly called out. And they must be prohibited, are prohibited from engaging in transactions with the donor or donor's family. In other words, it's got to be always arm's length transactions, except again, this is actually a prohibition for transactions, not just a arm's length transaction. Ordinarily, gifting, as well as estate, as well as income tax, you know that the normal rule is arm's length transaction. That does not apply here. The reason I emphasize it is because a friend of mine had a client who got in trouble for having a transaction between the family member and a foundation. Foundations can pay reasonable salaries and expenses for services by donors' family members, for example, serving on the board of directors or board of advisors. And I found that many of the foundations are set up for purposes of really providing income sources for family members on a tax advantage basis. Qualified retained interest gifting charities, these are the, let's see, 3, 4, 5, 6, 7, 9, 10. 10 we're going to go over in this class. Real quickly, CRAT, Full Income Trust, Charitable Lead Trust, Charitable Gift Annuity, Bargain Sale, Wealth Replacement Trust, Donor Advisory Fund, Qualified Personal Residence Trust, and Conservation Easement. This is not a total list by far. Again, lawyers have come up with thousands of different methods. These are probably the most common, however, that I've been able to find. So that's why I'm using here, just to give you a flavor for what you can do with your client, and also show you some how creative tools people have used. The CRAT, of course, is not very creative. It's been approved by the government and has been around for a few years now. It's a charitable remainder annuity trust, very similar to the grantor retained annuity trust. You put the funds in a trust, there's an annual fixed income stream paid to the beneficiary, and the remainder interest goes to charity. Relatively straightforward. If you're dealing with a charity, they can set them up very fast. Nice and simple is the best way to put it. And for people who like to keep things simple, this is a great way of giving to a charity and getting the asset out of your estate. The CRUT, again, very similar to the grantor retained unit trust. We put the assets into the trust, and there's certain requirements here. We must have an income of at least 5% of the annual value assets to the non-charitable beneficiary. The remainder interest goes to the charity. Again, like the CRUTs we talked about, like the threats we talked about. We can add income assets to it each year, and the 5% or more, whatever value you take out here, could eat into the corpus, but it could also be less than total income, so it tends to be good that way. The big difficulty, quite honestly, is the annual appraisal, and if you have assets in that require difficult appraisal techniques, it can become very expensive. We have special rules applicable to CRATs and CRUTs, and let's go over the main one. Both require annual payments to be no greater than 50% of the initial fair market value of the trust assets, and the CRUTs have a percentage of assets required to be distributed annually cannot be greater than 50% of the initial fair market value of the trust assets. So you have a limit on the annual payments out. Value of any remainder interest that goes into the charity under either trust must be at least 10% of the fair market value of the assets on the date they were contributed to the trust. And that's what we have for Module 1.